Welcome back, everyone, to Chapter 3. I'm really excited to dive into our new topic today. In Chapter 2, we took a comprehensive look at financial statements, exploring the nuances of a classified balance sheet and understanding crucial metrics like profitability, liquidity, and solvency ratios. We also touched upon the foundational financial reporting concepts that underpin these statements. Today, we're shifting gears slightly to understand how all that information gets into those financial statements in the first place. We're talking about Chapter 3, the Accounting Information System. The Accounting Information System, often abbreviated as AIS, is fundamentally a system designed for collecting transaction data, processing that data, and then communicating the resulting financial information to decision makers. Think of it as the backbone of a company's financial reporting. This entire system relies heavily on what we call the accounting cycle. Now, the accounting cycle is the very basis of an accounting information system. While many modern systems are computerized, often referred to as electronic data processing systems, it's important to remember that the underlying concepts and principles remain the same, whether the system is manual or computerized. To truly grasp these foundational ideas, we will focus on a manual accounting system. At the heart of any accounting system are accounting transactions. These are economic events that require recording in the financial statements. It's important to remember that not every event is a transaction. A transaction specifically occurs when an asset, a liability, or a stockholder's equity item changes as a result of some economic event. And here's a key concept. Every accounting transaction has a dual effect on the accounting equation. Analyzing transactions is a core skill here. It's the process of identifying the specific effects of these economic events on the accounting equation. As you might recall, the basic accounting equation is assets equals liabilities plus stockholders' equity. This equation must always balance after every transaction. This means if, for instance, an individual asset increases, there must be a corresponding decrease in another asset, or an increase in a specific liability, or an increase in stockholders' equity to keep the equation in balance. Your textbook demonstrates this through what's called a tabular analysis, which clearly shows the effect of each transaction on these financial statement elements. For example, when a company recognizes revenue, incurs expenses, or pays dividends, it directly affects retained earnings, which is part of stockholders' equity. Let's talk about how we actually record these changes. We use accounts. An account is simply an individual accounting record of increases and decreases in a specific asset, liability, stockholders' equity, revenue, or expense item. Each account has three parts: a title, a left side, and a right side. This is where debits and credits come in. To debit an account means to enter an amount on its left side, and to credit an account means to enter an amount on its right side. The T account form, which visually separates these two sides, is really helpful because it reduces recording errors and helps in determining the totals and balances of each account. The use of debits and credits is fundamental to the double entry accounting system. This system is based on the principle that debits must always equal credits. Every transaction has a two-sided effect, which provides a logical method for recording transactions, helps ensure accuracy, and aids in detecting errors. Here's a quick rundown of normal balances, which indicate the side where increases are recorded. Assets like cash, equipment, and accounts receivable normally have debit balances. This means debits increase assets and credits decrease them. Liabilities, such as notes payable, accounts payable, and unearned service revenue, normally have credit balances. So credits increase liabilities and debits decrease them. For stockholders' equity, common stock normally has a credit balance, meaning credits increase it. Retained earnings also typically has a credit balance as it represents net income kept in the business, thus increasing equity. However, dividends are an exception. They normally have a debit balance because they represent distributions to stockholders and therefore decrease stockholders' equity. So debits actually increase dividends. Finally, revenues like service revenue normally have credit balances because they increase stockholders' equity. Conversely, expenses such as rent expense and salaries and wages expense normally have debit balances because they decrease stockholders' equity. Once we understand how to analyze transactions and apply debit and credit rules, we move to the recording process itself. This process consists of three main steps. First, analyzing business transactions, which is often supported by source documents like sales slips or checks. Second, journalizing the transaction. And finally, posting to ledger accounts. The first formal step is using the journal. The journal is an accounting record where transactions are recorded in chronological order. It shows the complete debit and credit effects of a transaction, provides a chronological record, and helps prevent or locate errors. The process of entering transaction data into the journal is called journalizing. When you make a journal entry, the account to be debited is entered first, at the left, followed by the credited account, indented on the next line. Amounts are recorded in specific debit and credit columns, along with a brief explanation. After journalizing, the next crucial step is posting. Posting is the procedure of transferring journal entry amounts to ledger accounts. This is where the effects of all those individual journalized transactions get accumulated in their respective accounts. And where do they go? Into the ledger. The ledger is a record of all accounts maintained by a company and their amounts. It provides the balance in each account and tracks changes. The most common ledger is the general ledger, which contains all asset, liability, stockholders' equity, revenue, and expense accounts. Finally, after all entries are journalized and posted, we prepare a trial balance. This is done at the end of an accounting period. The primary purpose of a trial balance is to prove that total debits equal total credits after posting. It's essentially a list of accounts and their balances at a given time. This makes it incredibly useful in the preparation of financial statements and can also help uncover certain errors in journalizing and posting. However, it's vital to understand that a trial balance has limitations. It does not prove that all transactions have been recorded or that the ledger is completely correct. A trial balance can still balance even if a transaction isn't journalized at all, if a correct journal entry isn't posted, if an entry is posted twice, if incorrect accounts are used, or if offsetting errors are made in recording amounts. This means that while it's a great internal check, further verification is always necessary. Getting the basic transaction right is the foundation for relevant and reliable financial statements. Incorrect or inappropriate transactions lead to distortions in financial statements. So, understanding this system is key to ensuring the accuracy and integrity of the financial information we discussed last chapter. That wraps up our overview of the Accounting Information System. We've covered what it is, the importance of the accounting cycle, how transactions impact the accounting equation, the role of debits and credits, and how we use journals, ledgers, and trial balances to record and summarize financial data. Hopefully, this has given you a clearer picture of the careful process behind financial reporting. Next, we'll build on this foundation by exploring when transactions are recorded, a question at the heart of accrual accounting. It's a shift from structure to timing, and it's key to understanding how financial statements reflect economic reality.